Philip, we were talking about the bond market. How is this going to impact homeowners and especially mortgage owners? Because I think that's a big concern.
It is, and we have to think about that in terms of what it means for mortgage rates going forward. So we're at projections are that the Bank of Canada is going to be at a level where interest rates, or anyone renewing a mortgage at the end of this year, will be renewing at a higher rate on a 5-year basis than where they were 5 years ago. And this is likely to be the case over the next couple of years. So mortgage rates are priced off of the 5-year Government of Canada bond. As expectations for the Bank of Canada to raise rates have been priced into the market, that 5-year bond yield has been moving up fairly steadily. What that means is mortgage rates are moving up. And this is a theme that I think is going to persist for the next year to couple of years. Again, it's all tied to inflation, rate expectations. So mortgage rates are going to follow that. So anyone renewing a mortgage this year is going to likely see a higher renewal rate than where we were 5 years ago. Same thing next year. And as we go into 2024, that could be the case. So basically means mortgages are becoming more expensive.
I want to switch gears and talk about the markets. How are you reading the TSX and the S&P? And I guess what everyone wants to know is there a safe place to kind of park your money, especially when you see bonds reacting, the same way equities are? We're not seeing them being more uncorrelated, I guess, if that's a way to explain it.
Yeah, equities and bonds have been highly correlated this year when they're both down, right? Where do you go? The interesting thing is the Canadian stock market has been a great beneficiary of the inflation that we've seen. Why is this the case? Well, energy prices going up, oil and natural gas going up. That's good for energy stocks, the energy sector. When you see gold moving higher, whether it's on a risk-off move or it's due to the just inflation, using gold as an inflation hedge. When you look at copper prices, when you look at nickel, the materials sector has been benefiting from the inflation. And then the financials have been benefiting from the higher interest rate environment. Financials, the banks in particular, do well when interest rates are rising. So the Canadian stock market has been the bright spot as far as the global equity universe is concerned. It's positive year to date. It didn't see the same correction that we saw in the United States or Europe or other areas around the world. So that's actually been one of the best places to invest. And going through the remainder of 2022, I think it'll continue to be a very attractive place to invest. Now, when you talk about where do investors go for perhaps a safe haven, we need to look back in history for this. When we're in a period of higher inflation and rising interest rates, so as we've seen, bonds aren't necessarily a great place to be from an income perspective and also from a safety perspective. Well, one of the lessons that we've learned in the past, you have to go all the way back to the 50s for this, but dividend growing stocks are a great way to maintain current income, see that income increase in an inflationary environment, and protect your wealth as stocks actually tend to do well with inflation.
Okay. What about your suggestion for those who are heavily weighted towards techs? It's been interesting, right? We saw valuations, sky high, and now you've seen a massive sell-off, and it doesn't feel like many of the tech plays have been spared.
No, this is where the NASDAQ, we saw a full-on bear market in the NASDAQ. The NASDAQ 100 fell by more than 20%. Now it has recovered more than half of that. But as you point out, tech companies are expensive. They remain expensive. This is an area of the market that you could see further headwinds. And the reason for that being is high valuation stocks, if we look at it on a PE basis, they tend to bear the brunt of rising interest rates and higher inflation because the future earnings are being discounted at a heavier rate than a company that is fairly mature and fairly stable. So I think that the tech sector could still see some headwinds, could still see some downside. It's an area at the beginning of the year that we were less enthusiastic about. And even with the correction that we've seen, or the bear market, the shallow bear market that we've seen, that doesn't change my view that this is an area of the market that is prone to more downside going forward.
Okay, and then are they able to pass on costs? We only about 15 seconds, but are tech plays typically, are they able to pass on some of the inflationary problems?
Well, yeah, it depends on the tech company. If you look at
Yeah.
like a Microsoft or an Apple, these are great technology companies. Facebook, the same thing, that could stay ahead of inflation. These companies aren't overvalued in my view.
Yeah.
It's the ones that are trading at 60, 70, 80 times earnings that I think are going to face the most headwinds.